the U.S. economy grew at a healthy 3% annual rate as of the latest Q2 GDP report. However, as the Federal Reserve signals that interest rate cuts are likely, what are the risks? A 2024 recession is generally seen as unlikely, but metrics that economics take seriously hint that a recession could occur, perhaps in 2025. 2 key indicators. Call a recession. 2 historically proven indicators suggest a recession could be coming. The first is the SOM rule. This implies that when inflation rises materially within a year, a recession is likely on the way. That's because jobs are so important to the economy. When people lose their jobs, they typically cut back on spending. That can slow growth. For example, the Employment Situation Report for July 2024 showed unemployment at 4.3%, up from 3.5% a year earlier. These are still relatively low unemployment figures, but the increase is a concern for some economists. Secondly, the yield curve has now been calling for a recession for 2 years now. Currently, analysis by the New York Federal Reserve suggests that using the yield curve metric, the chance of a recession in the next 12 months is about 50%. Essentially, this analysis implies that as the Federal Open Market Committee raises interest rates, as they have done up to July 2023, so a future recession becomes likely. That relationship is historically robust. However, this economic cycle has been unusual in many respects, and the yield curve indicator has been wrong so far. Assessment of a 2024 recession. A recession typically comes with 2 quarters of negative growth. We're running out of time for that to happen in 2024 because the first half of the year saw positive economic growth. Therefore, if a 2024 recession were occurring, it would have to have already begun. Of course, that's not impossible given the economic data is reported with a lag. Forecasting Market Kalshi currently puts the chance of a 2024 recession at around 9%. However, some economists are more pessimistic. For example, JP Morgan estimate a 2024 recession probability of about 1 in 3 as of August 15th, based primarily on labor market risks as well as some softness in manufacturing and the euro area. However, it is worth noting that economists do have a record of forecasting recessions more frequently than they occur. What to expect? The stock market is a powerful recession indicator too. It often declines ahead of economic weakness. After some concern in early August caused a sell-off, the S&P 500 has currently rebounded to almost its recent high. This suggests a recession may not be imminent in the eyes of financial markets. Nonetheless, correctly calling a recession is a challenge, and the 2 metrics that do have particularly impressive forecasting records are calling for a recession currently. These are the SOM rule and the yield curve. However, there have been many unique aspects to the pandemic recovery, and relatively robust recession predictors getting it wrong may be another quirk of this economic cycle. Still, the next jobs report on September 6th will be closely watched. Unemployment has been on a steadily increasing path for 2024, albeit of historically low levels. It remains to be seen to what extent the U.S. economy can continue to grow should unemployment move up further from here. That wraps up our deep dive into whether a recession is on the horizon for the U.S. economy. We've explored various indicators and expert opinions, and while there's no crystal ball predicting the future, staying informed and prepared is always a wise strategy. If you found this video helpful, be sure to like, subscribe, and hit the bell icon for more updates on economic trends and financial insights. Thanks for watching, and I'll see you in the next video.